This is Tom Kozlik, the head of public policy and municipal strategy at HilltopSecurities. Thank you, everyone, for joining us today for this episode of our HilltopTalks Politics and Finance podcast series for 2024. During these HilltopTalks podcast discussions, we speak with subject matter experts about topics that intersect the world of politics and finance at the federal, state, and local levels in the United States. We often concentrate on issues related to the U.S. public finance and the U.S. municipal bond market. Today's guest is going to inform us about what is happening in a specific area related to U.S. financial institutions and shed some light on what is happening in the financial sector for us. I want to welcome Kris Johnson. Kris is a senior vice president at HilltopSecurities in the financial strategies team, where his focus is advising depository clients on balance sheet management, risk management, and strategic management. Our conversation today is going to be centered on what is happening with U.S. financial institutions. Specifically, we're going to be taking an inside look at their outlook for 2025, as well as the strategies and tactics they are enacting to begin 2025. Their outlook and their strategies are especially important considering the recent market volatility and anticipated policy changes given the red wave election results from last month. Kris, I'm looking forward to discussing the ever-changing landscape. Welcome back to the podcast.
Thanks, Tom, and it's a pleasure to be back, as always.
So a lot's transpired in the last 6 months since we recorded, I want to say back in June or July. Since our last conversation, we've experienced, on the one hand, what first comes to mind is relative, but I'd say pretty significant changes in the economic, market, and political environments. Let's tackle those topics individually in terms of how it is that you have shaped, how it is that you think that they've shaped the industry. And let's kind of start with a broad perspective with the economic picture and its impact.
Yeah, well, thanks, Tom, and happy to tackle, kind of the impact of the economy in terms of, what it's meant for the depository institutions and the clients that we work for. And, in general, the economy has been fairly stable. If you look at GDP, GDP has expanded at a pretty solid pace, with the labor market, slightly weakening, especially over the last couple of months. But, again, some of that is due to what we've seen with, the hurricanes in the Southeast. You had the Boeing labor strike. And a lot of that's going to need time to catch up, through, and that will represent itself in some of the jobs numbers that we come to see in the months ahead. So that part of it is sort of thrown, a blip in the radar. Then the other piece that, the Fed and things that we're really focused on, from a depository standpoint, is inflation. And, that has increased of late, but it appears to be pretty stable as well. So, with respect to the economy, what it's doing to the market environment, the market environment has really been something that, has been quite volatile. And I take us back to where we were at the beginning of 2024, where we had 6 to 7 rate cuts projected by the Fed. We fast forward to the last time you and I talked, which was the middle of the summer. That was one rate cut that was priced in by, I believe, the election date or slightly after. I believe the FOMC decision came 2 days after the election this year. And then we go into, just after Labor Day, where, the labor market did start to, maybe show some signs of weakness. We saw some instability in some of the other economic indicators, and the Fed went out and cut by 50 basis points in September, which, was a pretty marked change, and, certainly something that we weren't expecting, from a few months back. Then we got another cut right after the election by another 25 basis points, and now we've got, potentially another 25 basis points cut by, probably the time this podcast airs, for the December 18th decision. So we're going to have 100 basis points, cumulatively from the beginning of the year, of Fed rate cuts, which, certainly from a depository perspective, they look at that relatively favorably, given the fact that, it's going to reduce cost of funds. Pointing back to some of the topics that we talked about in our last podcast, a lot of that funding is really pegged or related to the short end of the yield curve, and that's going to be a tailwind for depositories heading forward. So, I think folks are looking at that in a relatively favorable view.
So that's that's the interest rate environment side. What about the political side? The last time we talked, Joe Biden was still the candidate in the race, with now former President Trump. He's now president-elect, and I mentioned the Republican wave that is going to be starting on January 3rd. How are banks reacting to that? I'd say the red wave, at least from my perspective, the red wave was a little bit of a surprise. How is the financial sector and how are bankers reacting? How are they preparing for 2025 as a result of that red wave?
So it's gotten a lot of optimism from the depository standpoint, and a lot of that has to do with the potential for a wave of mergers and acquisitions. And heading into the Biden administration, there were roughly 5,000 depositories, community banks in the country that were shrinking at an average rate of roughly 2%, or at 200 banks per year, which equated to roughly 5% of the industry. When we hit COVID, obviously there was a lot of risk that was posed. M&A completely shut off, or we kind of called it a rain delay, so to speak. And then we had Biden get elected in 2020, and that threw in all kinds of regulatory headwinds and things that really slowed down the application process and the process for regulatory approval for those deals to get done. And the median days to actually, from the announcement of a deal to the deal closing rose pretty significantly. And if you look in, especially in the larger bank space, let's call it the $50 billion and up space, those were going from 6 to 9 months to closing to over a year to up to 18 months to closing, and that really put a thorn in the side of the industry in terms of consolidation and what we saw from an M&A perspective. I think there's cautious optimism around the Trump administration taking over to have some more activity in that space, and I think ultimately people are going to want to see who are going to be the heads of the different regulatory bodies, who's going to be sitting on the banking committee, and understand who those lawmakers are going to be, what their policies are going to be. The management and boards of depositories are going to want to have conversations with those folks and get a really good understanding of what the playing field is going to look like, before we see any considerable impact in terms of M&A going forward. But ultimately, I think it's going to be a net tailwind as well for the industry in terms of consolidation. Folks that were typically serial acquirers in the past, doing more than one deal per year, might have an opening to start to go down that track again. The other piece of that is going to be tax policy, which I think when it comes to strategic growth and M&A, that's going to be the number one issue for the depositories. I do think corporate tax policy is going to be another piece of it too that comes through, and I know, Tom, certainly you've got some thoughts there on the tax side of things.
Well, with the Tax Cuts and Jobs Act provisions expiring at the end of 25, there's definitely going to be a lot of talk about what it is that lawmakers are going to be doing on the tax side after they figure out what they're going to be doing. On that first piece, from what I understand, I think that lawmakers want to get something done on immigration. There are some over the last week or so who have said that they'd like to include the tax policy in something within the first kind of quarter of the year. But I don't think that has really gained traction, but we'll have to see what happens over the next couple of weeks. So given all the major developments on the economic, the interest rate, and the political side, Kris, what do you think what major themes have you encountered, I should say, as the depositories finish up their budget and strategic planning conversations at the end of the year here?
So heading into 2025, we're on the tail end of what we call budget season and strategic planning season. Obviously, the election was a big part of that, and a lot of folks actually delayed, when they were going to start having those conversations to see what the result of the election was going to be. So a lot of that didn't really get, traction or momentum until, the beginning to middle part of November. Since then, there are, a number of things that, are playing into the, strategic cauldron, we'll call it, of what institutions are thinking about from, managing their balance sheets, how they want to grow their business, what type of customers they want to go after. Should we grow? Should we shrink? Should we buy? Should we sell? There's a lot of, turmoil, I guess, in terms of where banks want to go. Not only given what the impact is of the market and the political environment, but also, technologically. And we talked a little bit about that on our last podcast, is some of the technology developments with generative AI and how that's being integrated into banking. And, right. Ultimately people are trying to, be more efficient and drop, more dollars down to the bottom line, from that perspective. So there's quite a lot that people are having to tackle in these sessions heading forward. But, as we look at things and myself and my team here at HilltopSecurities, we're really focused on the balance sheet and balance sheet management heading forward. And, ultimately, building a fortress of a balance sheet allows you, as an entity to be able to execute, whatever growth plan it is that you have, or whatever tactical or strategic plan that it is, for your boots on the ground and your relationship managers. So, a couple of themes that we've seen, since the last time we recorded, we had a release of third quarter earnings, which showed, quite a bit of activity in terms of banks restructuring their balance sheets. And I think a lot of that is going to spill over into Q4, as well as the early part of 2025. And, just a couple of, key themes to highlight and hit on here, as banks are seeming to be more able and ready to raise episodic capital, ultimately to restructure their balance sheets. And a lot of that comes from, the underwater marks on the bond portfolio. It could be the, fixed rate loan portfolio that is now, underwater from a mark to market value perspective. That paired with, their shorter liabilities and their higher cost of funds, margins have really compressed on the wholesale balance sheet, and banks are really taking, this time to say, we've got a lot of uncertainty in terms of what the political landscape looks like, where the playing field might be open in terms of M&A and that type of activity. So let's focus, on homegrown strategies and basically keep our house in order. And a lot of that has led to optimization of capital, either internally through shrinking the balance sheet, creating more capital shelf space, or strategic raises, as I mentioned, where banks will actually go out and raise equity capital, take a loss in their bond portfolio, and say, we're going to live to fight another day because we're sick and tired of looking at bonds that are yielding 1.5% on our balance sheet. We got a higher and better use for that capital, which is going into loans. It's paying off bank term funding program funding at, rates upwards of 5%. There's a lot of upside down leverage that exists in that wholesale balance sheet that banks are looking at unwinding. Shrinking the balance sheet is another piece that is maybe less desirable. There aren't a lot of banks that say, hey, at the end of the day, when we go into, the next year, we're going to say we want to be a smaller institution. Everybody's always trying to grow. Everybody's always trying to make more money. I've never seen a bank that says we want to be smaller. We want to earn less money next year than the year before. But, we're also in a position where we're coming out of COVID. There's been a lot of headache, a lot of heartbreak, and a lot of hangover in terms of the amount of capital, liquidity that was deployed into that environment. And now folks are saying, we are getting into the position where we want to right size, we want to position ourselves for, this incoming administration, a rate environment that has seemed to stabilize, where we're seeing, the sell-off that we had right after the election, the 10-year hit almost 4.5%. that has slowly ground down, inside of, 4.2% and getting closer to 4%. Same thing with the 5-year, where we're seeing, better valuations in terms of a mark to market perspective on some of our assets, but we're also seeing, kind of the erosion of what the opportunity is to reinvest in that wholesale portfolio, be it bonds, be it payoff funding, et cetera. So a lot of right sizing is happening as well. And again, I think that's something that we'll continue to see into Q4, and we'll see those earnings releases at some point in January of 2025, and we expect that institutions are probably going to continue to execute those types of transactions throughout the first quarter of 2025.
So it sounds like you and your team are very focused on the balance sheets for your clients. Are there any other specific strategies that come to mind in terms of restructuring balance sheet?
Yeah, I think a lot of focus, outside of the asset side, which again is going to be really predicated on the wholesale side of the balance sheet. There are opportunities that we've seen, folks being more focused on in the liability side, which, would entail, brokered funding, Federal Home Loan Bank funding, paring down some of those portfolios, and I guess maybe more focusing on, core deposits, things that are more franchise value drivers for these institutions. Those deposits are a little bit harder to come by, and they were hard to come by 5 years ago. I think as the retail deposit base has woken up, and I can move money from my Bank of America account to basically any place in the country that I want to move it to get to a higher savings rate or earnings rate. Folks are dealing with that with their own core deposit base, and they're trying to be really careful about that. So again, kind of the wholesale funding is being used as kind of a weapon, I guess, to mitigate waking up people's depositor bases, especially as we go into a lower rate environment where I'll give you 1%, 4 years ago to now I'm giving you 5%. Well, if rates drop 100 basis points, I can't go from 5% to 4%. If I'm doing that, I'm showing that I'm being very rate sensitive as an institution, and I don't want to wake my depositor base up to that too much. So banks are having to be really careful about how they walk back their funding costs, in conjunction with maybe sliding in different portions of wholesale funding, be it via brokered CDs, Federal Home Loan Bank, and other sources of wholesale funds to sort of make up for whatever funding it is that they need, whatever runoff that they could potentially have from lowering funding costs or lowering deposit costs, but ultimately trying to keep the customer happy, because that is probably the most valuable commodity in community banking is the deposit base. And we're getting into a point where we had a lot of risk on the way up with net interest margins decreasing because we couldn't raise our asset yields weren't going up high enough relative to funding costs. It's going to be a similar situation on the way down, as deposit rates probably aren't going to fall as much as people are hoping, just given the fact that everybody's been woken up to the ability to move money as quickly as they can, and what their opportunities are to earn money or earn a return on their deposits elsewhere.
So I know you and your team are also focused on portfolio management. What are some of the portfolio management tactics that you're discussing with your clients who might have excess liquidity to invest these days?
Sure. So there are some pockets of community banks out there that actually have excess liquidity and are willing to put that to work into the marketplace today. Obviously, as we saw the liquidity crunch from 2023 and how a lot of the banks got hurt very badly due to deposit outflows and liquidity risk issues stemming from a lot of longer duration, very low yielding assets that were purchased during the influx of cash that came from COVID-19. Folks are being a lot more cautious with portfolio management, and that's frankly something that we really advise folks today as they think about one, what is the next highest and best use for that cash? Obviously, it goes into loans. If it's not loans, is it paying off funding? If it's not funding, where can we replace our bond portfolio runoff? And what we're looking at is, really things that, you almost sacrifice spread, and we would talk about spreads in the bond world. We're talking about, what is the actual yield I'm earning, versus the benchmark treasury average life equivalent of whatever asset that I'm looking at. And so I will sacrifice a little bit of spread and take a little bit lower of a yield if I'm buying a bond that is structurally sound, meaning if rates go down, it's not prepaying, out from underneath me. And so if I've got a 4-year average life bond, if rates go down 100 basis points, that doesn't become a, half a year average life bond. Same thing if rates go up. If rates go up 100 basis points, my 4-year bond doesn't become a 6-year bond. And so people are really focused on predictability and stability in the bond portfolio. And they're not really willing to, reach too much in terms of structural boxes to, grab a whole lot of yield, one way or another. And predictability and stability is really the name of the game right now. I don't see people overly shortening bond portfolios, which I think was one of the themes that we were expecting to see as part of the fallout that we saw in the spring of 2023, where folks had very long duration securities portfolios. There's a lot of municipals. There was a lot of 30-year mortgage collateral that was tied up in that, which if you tried to get out of that and find a bid in the market, you were going to take a pretty punitive loss. Where I think at this point it really is all predicated around structure. And at this point there's something to be said about just kind of living with plain vanilla. And I can hit a drive 300 yards down the middle of the fairway, but sometimes I can slice that and it's going to go 400 yards to the right. I'll take the 200-yard drive down the middle of the fairway and live to hit another shot and not take a penalty stroke. And I think that's the approach that a lot of the banks have taken in terms of managing their bond portfolios right now.
Okay, that makes sense. Thank you. And Kris, thanks so much for joining us today on the podcast. Let's make sure that not so much time goes by by the time that you come back and talk to us, because I have a feeling, as we've been previewing, 2025 is going to be a busy year.
I agree with you, Tom. Let's not be strangers, my friend.
And thanks very much, everyone, for joining us. For those interested, you can also see the recent Hilltop Securities economic and municipal commentary and listen to our podcast by going to HilltopSecurities.com/commentary, and you can follow me on Twitter and LinkedIn. The podcast can also be found on Apple and Spotify. Thanks again, everyone. We look forward to bringing you more color in the future related to topics that intersect the world of politics, finance, and public finance. This has been Tom Kozlik from Hilltop Securities.